Hi, I'm Jimmy. In this video, we're going to walk through a quick review of where the US economy stands. We're using a few different economic indicators to see if we can objectively get a big picture of the broader economy, and hopefully we can use this information to help us make better investment decisions and ideally get us closer to our goal of achieving financial freedom. Okay, so let's jump right in. So our first economic indicator is the Baltic Dry Index. This Baltic Dry Index is based out of London, and it tracks the cost of shipping goods via ship. Basically, it tracks the cost of shipping goods for 3 different ship sizes. And the goal here is to see if we can get an idea of the recent trend for the supply-demand of shipping mostly raw materials. And as we can see, thanks to the coronavirus in early 2020, this indicator was right near its low, implying very limited demand and an oversupply, which makes sense given that many economies around the world were shut down. Since then, it appears that the pricing has recovered, implying an increase in demand, which is overall a positive thing for the broader economy. So when we jump over to our scorecard, well, now on this scorecard, it makes sense to give this point to the bulls. We're going to give a point to the bulls whenever things look good, and a point to the bears whenever things look not so good. Next up, we have our ISM Manufacturing Economic Indicator. Now, this indicator is a bit unique in that it tracks new orders, production, supplier deliveries, and a few other manufacturing-related metrics. The key level for us to pay attention to here is 50. Anything above 50 implies that there's growth in manufacturing. Anything below it, negative growth. Now, last month, we marked this as a point for the bulls since the most recent number showed a jump above the 50 level. And that's a good thing. And when we update this chart with the most recent information, well, now we can see that manufacturing picked up even more ground, which is a good thing for the broader economy. Now, before we mark this down as a point for the bulls, I just want to point out the fact that notice this chart goes back to July of 2011. And notice I said July and not August, even though we're almost into September at this point. And the reason for that is that this data is basically a month lagged. And that's one of the drawbacks of many different economic indicators, is that oftentimes they only come out fairly infrequently. Sometimes monthly, sometimes some even come out just quarterly. So they're not quite as useful as some of the more often economic indicators. That being said, we move back to the scorecard, and here we're going to mark down a point for the bulls. And now we shift over to initial jobless claims, which is a weekly number. And thanks to its more frequent appearance, sometimes it can be a bit more useful. Now, what initial jobless claims tracks is the amount of new people that are filing jobless claims. So these are the people that recently lost their jobs. And as we can see with this huge spike here, it appears that one of the primary reasons at this point is the coronavirus. Now, there are some holes at looking at just initial jobless claims, because one example is that if somebody loses their job, well, they hit the initial jobless claims. If they get that job back, well, they don't take it away from here. These are only new jobless claims that hit this report. Unemployment accounts for some of the jobs coming back, so we'll look at that in a second. Now, for me, and the reason that this is certainly going to be a point for the bears, is it's really how high this number is that is the biggest concern. I understand the enormous jump from the coronavirus. That makes sense. But the most recent number is still 1 million new jobs being lost each week. And those are huge numbers. And as long as those numbers are this high, I think it's going to cause a constant drag on the broader economy. Now, if we want a more slightly rounded picture of the jobs situation, it could make sense for us to look at unemployment. Unemployment is another one of those monthly numbers, so it's not quite as timely as the initial jobless claims, but there is some overlap here. So we can see that there was an initial jump in unemployment, which makes a lot of sense. But since then, unemployment has been trending lower. So we can assume, basically, this tells us that we know that if initial jobless claims are 1 million plus a week, well, in order for unemployment to be falling, there would have to be new jobs hitting the market at a rate faster than the 1 million jobs a week being lost. But we still have unemployment of about 10%, which is terrible. Now, I know we could talk about U3 unemployment doesn't really track. It's not a good number to look at. I've heard many people argue about the inefficiencies of unemployment, and that is true. But the real inefficiencies are that unemployment in theory doesn't show, not this number at least, it doesn't show if people are underemployed or perhaps they stop looking for work. So yes, there are some holes in it, but in all those situations, that would just make this number worse. Either way, these are going to be 2 points for the bears for both initial jobless claims and unemployment. So right now on our scorecard, we got a head-to-head matchup, 2 points for each. Now we're sliding up to housing starts. And basically, housing starts tracks the number of new houses being built. And we can see that new housing starts trended higher for a long time after the financial crisis. And then when the coronavirus hit, well, housing starts fell, which is logical. But then as things have been opening up, well, housing starts have jumped right back up. So this is a fairly good sign for the broader economy. New houses usually means that more people are buying houses, which helps with construction jobs, and new houses usually lead to people putting things inside those houses, furniture, things along those lines. So overall, this could lead to a more robust economy. So we've got another point for the bulls with this one. Now, last month, this one actually landed in the neutral territory, and that was partially because I was afraid of jumping the gun with it. But because it has consistently been up a little bit higher, up near where it was, well, I think it makes a lot of sense to give this point to the bulls. Okay, now we move over to consumer confidence. So we can see with this chart that this goes back to before the financial crisis. And before the financial crisis hit, consumer confidence was fairly high. Well, then consumer confidence fell as the financial crisis hit the economy. And then there was a gradual recovery. There was a gradual buildup from the lows off the bottom of the financial crisis. And that took a few years. And then the coronavirus hit, and once again, history repeats itself, and consumer confidence takes a hit. Now, I do think it's a reasonable assumption that this will gradually come back just like it has in the past. But it is likely to be gradual. Now, I do think it makes sense for us to give this point to the bears, since at this point it is still negative. Okay, now this brings us to the Federal Reserve. So this one's a really tricky one to come up with a clean analysis for in a simple chart-like form like we've done so far. And that's because they influence so many different parts of the broader economy. For example, the Federal Reserve has been buying up mortgages, bonds, government treasuries, and clearly that puts a lot of cash into the system. And that has the potential of causing inflation. But it does lead to more capital into the economy, which could lead to more growth. Then they lowered interest rates, which should help spur additional spending, could lead to more houses being bought, like we mentioned before. But since rates are so low, well, they really might have used a lot of their dry powder that they had. So once again, for every potential positive for an action that the Fed takes, that comes with a potential negative. So I think we need to be super careful about jumping to any definitive conclusions about what the Fed is doing. I've seen way too many videos or read different articles about people are talking about what the Fed is doing, and they're coming up with an end game as if it's defined in stone already. And the Fed could, in theory, make things okay. They could also bomb this whole thing. So for now, I think it's only fair to mark this down as neutral, because I do think that what they're doing is somewhat dangerous, but it also makes sense from an economics perspective. I do think it makes sense for them to put cash back into the system, try to spur the economy along until things get better, but there's risks with what they're doing. Now, despite those risks, I personally think it still makes sense to continue to be a smart investor during these times. I'm a big fan of dollar cost averaging, where you just invest the same amount of money on whatever the frequency is on your own schedule. You just keep investing it almost no matter what the stock market does. When things are lower, you buy more because the same amount of money buys more. When things are higher, you buy less. So it's a good way to invest. I'm also a big fan of strategically investing, where we're looking for individual companies that could do very well. I understand the risks of investing from a broader economic standpoint, but I think trying to time the market is a very, very dangerous and very difficult thing to do. People have been talking about the great implosion of the stock market for decades, and I believe we're sitting at all-time highs right now, albeit somewhat unwarrantedly, thanks to the Fed mostly. And if you're curious, I actually did a video where I walked through what the Fed is doing and the fact that whether or not they are actually creating a bubble. Now, if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.